I'm Teneale.
And I'm Kelsey, and we're financial advisors from Allman Partners True Wealth, bringing you thought-provoking conversations around you, your money and your life on the Wealth Experience podcast. Welcome back to the Wealth Experience podcast. We're going to be doing a series of bite-sized technical financial sessions to give you information that you need to help you make smart financial decisions for your future. So Teneale, where do we begin today?
Today we're going to be talking about super contributions and the confusion around that topic. So I know it's not the most exciting topic on the outset, but honestly it is a very confusing one and we did want to address it. I know even when I was in my early 20s, I actually had a close friend who she had a super balance that was about twice as much of our friends of a similar age group and income level. You know, she went to having a bit of a catch up and she mentioned this is where my super's at. And it was a little bit eye-opening at the time. I suppose a big reason why that was the case was actually just a small amount of super contributions that she was making into her fund every week, and it was actually only around $20. But that can make a huge difference over 30 plus years of working lifetime, right? And so I thought today we were going to talk a little bit more about superannuation contributions. And so, Kels, can you tell us a little bit about what you see in this space?
Yes, absolutely. I wonder where your friend got her advice from to do that so early in her 20s. Obviously, someone must have had a good conversation with her. So that's excellent that she was doing that. But a common question that I do get is, why would I even want to contribute to super? The government's going to take it. I do hear that quite a lot. There seems to be a lot of distrust between super and the government and the link there.
Yeah.
Or, you know, I'm so young, I just want to pay down my home loan. So what would you say to those objections, Teneale?
Yeah, it's definitely, you're right. We get that quite a lot. And to tackle the first one, you know, superannuation and the government and what control they have over that. And probably one of the myths that we try and bust firstly is that the government doesn't have access to your superannuation. Your superannuation is your own. They just set in place some of the provisions around, you know, how you get money in and how you get money out. And they actually haven't made a lot of changes in terms of the access age to super and how you get money out of there. So that's some of the education that we go into around that space. But if we're thinking about the other objection you spoke about, I'm quite young, I want to pay down my home loan debt. It's really got to be this balancing act though, right? Because if you've got a home loan in place and it's 30 years until that's going to be paid down, you might be 30 years of age and it's 30 years until you're accessing your super. So do we really want to get to the end of that space and have all the home loan paid out but nothing built in super?
And missing out of, you know, that opportunity of the growth and the compounding over that period of time, right?
Yeah.
So what we're saying is superannuation is a good environment and you should be paying attention to it as early as you possibly can,
yes,
in conjunction with, you know, all the other things that are going on in your life and your goals and all of that part. But really, really important to pay attention to it. So let's kick off with super confusion number one, which is, can you contribute if you're not working? And the answer is possibly. Some people think that, well, I'm not working, so I can't contribute to my super fund, right? Mm. And this can happen in lots of different situations. You could be retired, you could be on maternity leave, you could be taking a career break, whatever that may be. It looks different for different people. But there's a lot of rules around that, and that's why I say possibly, because it can be really, really complex, particularly if you're in your 60s to 70s. So let's unpack this a little bit today and delve into the details. So first of all, the first point is there was legislation changes on the 1st of July 2022, which meant that individuals under the age of 75 are now eligible to make voluntary contributions to your super fund, so ones that you elect to make without needing to meet the work test requirements in some instances.
And that's a bit of a difference because I think previously that was capped at age 65. Correct, so there's been some really good recognition from the government that people need to be getting more money into super. So they actually increased that provision and said, well, if people are working longer, even if they're not working longer and perhaps have some asset sales and whatnot, that they want to get money into the super environment, moving that to age 75, I think was a real win.
Yeah, absolutely. And that's a really big benefit. And you can use certain different provisions like the bring forward rule up to age 75 now, which is effectively before you could only use 1 year's worth of non-concessional contributions, which is $110,000 at the moment per annum.
And a non-concessional contribution, sorry, I'm just going to interject there, non-concessional being those after-tax contributions.
Yeah. And you can effectively bring forward another 2 years' worth of those to $330,000 to add that in as a lump sum to your fund all at once. And that can be a really big benefit for people. You know, some people downsize their home before the age of 75 and all of a sudden they've realised this capital that they want to do something with, they still want to have it working hard for them. And that's a really good opportunity for people to do that. Where it gets confusing is that the works test still does actually apply to those aged 67 to 74. So if you do want to make a concessional contribution, which is a tax deductible contribution, before we was talking about non-tax deductible contributions. So what does that mean? Well, in that age range, the 67 to 74, if you want to make that contribution to super and claim a tax deduction, you'll need to work for 40 hours during a 30-day consecutive period in the income year that you want to actually make that contribution. So whilst we're saying you can make contributions all the way up to age 75, if you want to have the opportunity to claim some tax deductions too, again, maybe you sold an investment property and that would be of benefit to you, then this is a condition that you still need to meet.
And so what do you actually mean when you're talking about claiming a tax deduction? What does that mean for our listeners?
Yeah, so great question. So a personal deductible contribution for starters is actually limited at $27,500 per person in a financial year. And it's important to understand all of this firstly, which includes your compulsory employer SG, your salary sacrifice, or any personal tax deductible contributions that you make in. So let's say a practical example of what I mean by a tax deduction would be your employer makes contributions of $20,000 per annum for you, and that's concessional. So that means that you have $7,500 left that you can put concessionally into your super fund. And instead of paying tax at your marginal tax rate on the $7,500, say, you would pay only 15% on the way into your super fund. Now, there's a whole other avenue of conversation there around various aspects and strategies that you could benefit from. But at a high level, that's what it achieves. It allows you to put more money in, get a tax concession for it up to that cap. Now, you might be wondering, what if I'm not working and earning an income? Is there a benefit for me to do this? And the answer is maybe.
You like your possibilities and maybes
Possibly
today.
and maybe. And this is why it's quite a complex area and there's lots of things to consider in your own personal circumstances. But if you have no accessible income, then there's not really much benefit in making your concessional contributions because there's no accessible income to offset.
Against, yeah.
But certainly, it doesn't mean you have to be working and earning an income. You might have other sources of income, such as an investment or a capital gain from a property sale, for instance. Then you can benefit from the reduction in accessible income from this type of contribution. So back to my previous example, if you put in $7,500 concessionally into your super fund, your accessible income would effectively come down by that much.
Yeah, absolutely. So you're getting that tax reduction, which I think can be a huge win, like you say, when you do have income coming from another source.
Yeah.
But I often hear that people think that you really have to have a high income, right? But let's think about an example of a situation where, like you say, you're not working or you've had a very low level of income. Maybe somebody that's taken maternity leave and they don't expect to earn any income in the current financial year for that reason, right? So, Kels, I mean, you're going to be there not too long away from now, taking some maternity leave.
That's right. Yep. Very exciting time.
If I'm in that situation, I'm taking some maternity leave, I've decided that maybe I'm going to sell an asset. Like you said, I'm selling an investment property, let's say, that I own jointly with my partner this year. Given how much growth we've had in property markets lately, it's likely to result in a large capital gain. And for instance, in this case, my accountant tells me that I have to pay, I'll have $75,000 worth of assessable income this year from that capital gain, which is, a hefty amount. What that results in, if I do nothing else, is taxes of over $16,300. So great, I've made some money on my property, but now the taxman's going to love me. what I could do is I could elect to use some of the money from the property sale and make a contribution into my super fund and claim a tax deduction like you're talking about. So in the 2024 financial year, and this is important, all these figures we're looking at the moment, they're all 2024 financial year. That amount is that $27,500. So my new assessable income position, instead of being the $75,000 that I've earned in the capital gain, I've made the $27,500 a super, so it's now an assessable income position of $47,500. Lots of figures going on there. I know. What does that do? It turns my $16,300 tax into around $6,500 worth of tax. So making the contribution did reduce my assessable income. It didn't negate the capital gain entirely, but it has reduced it by almost $10,000. So, Kels, when I claim that tax deduction, does that actually mean that I pay no tax on the contribution?
Unfortunately not, no. So with your concessional contributions, you do have to pay typically around 15% tax on the way into your super fund, which is why they call it concessional. So look, and that's why we say you've got to think about what is your assessable income for the year, because if it means that you'll be otherwise within the tax-free threshold, then there's no point doing the contribution, because you'd end up paying 15% tax that you perhaps otherwise may not would have had to have paid. So you really got to consider it for your own personal circumstances. But it is just a tax concession, in other words, a reduction to your tax rate.
Yeah.
So in your example, Teneale, your clients had a tax rate payable of 34.5% on the $27,500 of income if she received that as income. Whereas if she contributed to super, it reduces her overall tax rate on that money by 19.5% to the 15%.
Yeah, so that's where the concession lies, right?
Yeah.
You know, that 19.5% reduction is your concession.
Which is a cash flow benefit. So you feel that immediately.
Yeah.
So whilst you pay the tax in your super fund, you're not accessing that for a long time, but the cash flow benefit is instant.
Absolutely. And if we think about it this way, on her remaining income of the $47,500, if she does make that super contribution, her average tax rate ends up coming in at only around about 14%. So like you were saying, that's lower than the 15% tax rate on monies that she contributes into super from there. So it probably wouldn't have made sense, even if she could, to have made a larger contribution than that to the super environment.
Yeah, absolutely. But I would recommend, highly recommend seeking professional advice before you do actually take any action, because as you can see from our conversations, there's lots of trips and traps that is unique to each individual circumstance. So just to be aware of that. But let's
the confusion.
More confusion to the confusion. But let's jump to point number 2 around the super contribution world, which is addressing if salary sacrificing is worthwhile if you're on that high income.
So a situation now where I am earning a high income and I'm seriously considering building my super balance.
Yeah. And most high income earners that we meet want to reduce their tax. That's a huge factor for them. But I find it interesting that they're willing to spend money on things like lease cars, negative gearing to buy a property, which is where the costs are higher than the income, creating a deduction against their income tax. Interestingly, also risky assets that they want to invest in, such as crypto, and there's no income payments from them either. However, most don't actually consider, and probably don't want to consider, contributing to super to reduce their taxable income.
Why do you think that is?
Look, I think people want to feel the benefit straight away, and superannuation and contributing there is a bit of delayed gratification. And
a lot of delayed gratification.
Yeah, a lot of delayed gratification. And there's not a lot of education that's actually provided around the super environment. So unless you're in that world, understanding it and understanding the benefit long term for you, it's not where your head goes to. People think, I've got such a long time.
I'll do that later.
I need to get the benefit now.
Yeah, that's exactly right.
But with many strategies to reduce tax, you often are just giving away money for no benefit. That can happen. The thing that I'd really, really like about salary sacrifice arrangements that you can do is that you're keeping your money. Whilst it's not in your bank account, you can't access it immediately, it's still your asset. You're just putting it in your super fund. So you're still getting the tax benefit from that as well.
And that money's growing over time too.
Absolutely. And so a salary sacrifice to super is exactly what the name says. So you can choose to sacrifice your money from your pay, with your employer paying it straight into your super fund, under the concessional contribution cap, which we said was $27,500 at the moment. And this reduces your income by the amount that you sacrifice. And therefore, it means that you pay less tax in your everyday pay packet. And that's the most important thing. It's not a lump sum that you're doing like we was perhaps talking about before. This is salary sacrifice that you're doing, the tax concessional contribution, every pay cycle.
So doing it weekly, doing it fortnightly, however often that pay is. Or for those that are unfortunately getting paid monthly, doing it monthly.
That's right, yeah.
And I actually saw a young couple the other day. They were really good income earners. So the two that were there, Rebecca was earning about $120,000. Ryan was earning about $250,000. So when you think about that, those are some really good income, some high income earning situations, and they were easily able then to cash flow all of their own personal expenses, loans, all of those kinds of things. So considering salary sacrifice might actually be worthwhile for clients like that.
Yeah, and if you think about it like this, the client, Rebecca's marginal tax rate is currently 39%, including the Medicare levy, and Ryan's marginal tax rate would be 47%. Now, a little catch is that so long as you're earning under $250,000 per annum, the only tax you pay on concessional contributions up to the cap is 15%. But that $250,000 does include your super contributions too. So you do have to factor that in. So if you're earning collectively in your total package from your employer $250 plus, the tax payable is 30% on those concessional contributions.
Yeah, okay. So you're paying twice as much on contributions than what someone under 250 would.
That's correct. So it's still a concession because your tax rates are so high that even if you paid 30%, you're still getting a major benefit. So it certainly makes sense too. So as an example, Rebecca effectively saves 24% on every dollar that she puts into super, and Ryan saves 19% on every dollar that he puts into superannuation.
Yeah.
It just doesn't feel nice.
That Division 293 tax, the additional tax that you're talking about there on super contributions once you've earned over 250, it's an interesting one because just like you've explained, I often get clients wanting to talk about ways for the higher income earner to reduce their tax. So in this case, Ryan wants to reduce his tax. But as we've just spoken about, even though Rebecca's earning just under half the amount of income as Ryan, there's actually a greater tax benefit in her opting to use a salary sacrifice kind of strategy.
Yeah, absolutely. So you don't have to be at that highest marginal tax rate to benefit from this is what we're saying.
Yeah.
But let's move on because super contribution, confusion, number 3. Just because you don't get employer contributions doesn't mean that it's enough. I feel like this one's a really important one to address because it's quite easy to, I guess, plod along in life, go, I don't need to worry about my super, I'm getting employer contributions, I've been working all my life, I'll be fine. Now, we've just spoken a little bit about how you can add super yourself to your fund, but let's not forget that if you are an employee, we know there's mandatory employer super guarantee contributions that they do make on your behalf. It is increasing year on year at the moment. But is it enough?
Well, I mean, I guess the problem that we do face is that if an employee has built their superannuation over time just using those employer contributions, let's say we get someone who, I love examples, so let's use an example, is 60 years of age, so they've met their preservation, and they need $60,000 a year to live on for the next 30 years. They want their capital to last them. We put some assumptions around that. We say you get a return that's modest, just under 6.5%. Standard deviation. I know it's another one. It's another one. It's the volatility and level of returns of just under 6%. But somebody in that space needs around about $1.3 million in their super to be able to fund a lifestyle of $60,000 a year. So when we think about it like that, you go, well, that's a relatively big number, but I'm also getting employer contributions, which at the moment 11.5% of what's there. So that should be helping me along, right? Unfortunately, statistics show us that's not also the case. So an average account balance currently for a 60-year-old is across the board is $403,000 for men and $318,000 for women which is over 3 times lower what they would actually need in super to live on from retirement. So it's clear mandated employer contributions are just not sufficient to get people to a fully self-funded retirement.
Yep, absolutely. And I think that it's really hard for people to wrap their head around, because it's probably one of the biggest lump sums that you ever get access to by the time that you get there. So it feels like it's a lot of money. 400,000 probably feels like, oh yeah, I can live off that until I pass away. But oftentimes people aren't thinking about the inflation impact on that.
Yeah. Or the reliance on the age pension, right?
Absolutely.
So we know that the age pension's under pressure. What are we going to do when our generation gets there? And, will there be the same level of access? We assume not.
Yeah, absolutely. So moral of the story is employer contributions in most cases are probably not going to be enough for you to have the retirement lifestyle that you want, if you don't want your lifestyle to drastically change by the time that you get there. Now, that was supposed to be bite-sized information. I feel like there was a lot in there, Teneale. But hopefully that's been easily digestible. But let us know if you want us to delve any deeper into the points that we have raised today, and we can do that in another podcast. We are releasing, as I said, a series of technical but palatable, informative podcasts, so stay tuned for the next one.
See you next time on Wealth Experience. The opinions of the presenters are objectively ascertainable and are not intended to be financial product or personal advice.